What's good, YouTube? It's your boy Charles Enoch. You already know we back with another Invest in Myself episode. Let's get started. So next week, I'm gonna be refinancing a few of my HELOCs because the values of my properties have gone up a pretty good amount. I know you guys have been seeing the housing market and it's crazy in pretty much every area. So today we're going to be talking about how to use your HELOC when it comes to velocity banking. But before we get started, you already know I got to do the YouTube thing. So your boy is a few hundred hours shy of being monetized. So I'm going to ask y'all, help a brother out. So the new slogan, if the video nice, go ahead, watch it twice. And if you're doing it for me, go ahead, watch it for 3. Nah, but really though, don't forget to smash that like button for me. Make that thing turn blue. And if you're new to the channel or you've been watching several of my videos and just haven't done so yet, take a little time, hit that subscribe button for me. I really appreciate anybody that does so because it does help me reach a higher audience base. Also, don't forget to leave a comment down below. Let me know if you like the information, if you didn't like the information, what topics can I talk about in regards to velocity banking? That is also very helpful. All right. So for those that don't know, HELOC stands for Home Equity Line of Credit. So the bank is essentially going to give you a line of credit based off of the equity that's currently in your home. So for example, if I owe $200,000 on my home and the current value of that home is $300,000, the difference between the value of the house and the amount that I owe on it would be your equity. So in this case, my equity is going to be $100,000 because 300,000 minus 200,000, 100,000. Now, depending on your bank, they're going to give you a line of credit between 65% to up to probably about 95% of the equity in your home. And one thing to note, HELOCs are generally going to be lower than lines of credit because you're putting up your house for collateral. So for some reason, if you can't pay the HELOC back, the bank is basically taking your house. So since the bank can take your house, they're going to see this as a low risk, and that's why your interest rate is going to be lower. Now, there are first and second position HELOCs, but we're really not going to get into that on this video. So for this example, we're going to be using a home equity line of credit to defensively invest and pay off a pretty big loan. So you already know I got the whiteboard in the back, so we just going to get to it. Let's go. All right, so we're at the whiteboard. You already know we get straight down to business here. So we're going to say that we have a couple here and their income is going to be $5,000 per month. Their expenses are going to be $4,000, which means that their cash flow is going to be $1,000 left over every month. Now this next section, we're just going to go briefly over how the bank's going to calculate what they're going to be getting for their HELOC here. So this couple, how much they owe on their home is $200,000. Now the house value of the home is $354,000. So the difference is going to be $154,000. Now the bank will give 65% of that difference. So 65% of the $154,000. If we do the math, it's going to be about $100,000 for the HELOC. So these individuals' HELOCs that they got from the bank is $100,000. And this is based on the amount that they owe with the difference of the house value. So the terms of the HELOC, we're going to say is 3.5% interest. Now, we do have a little equation on how to calculate this simple interest here. So we're going to say that we use $40,000 on the HELOC. So there's $40,000 that we owe out of the $100,000 that they gave us here. We're going to times that by 0.035%, which is 0.035, which is 3.5%. Divide that by 12 because there's 12 months in a year. Our interest is going to be $116,000. So that's an example if we use $40,000. Now we're going to look at the loan and the terms of the loan here. So the amount of the loan is going to be $40,000, and we can say it's either car loan, student loan, whatever type of loan. The amount's going to be $40,000. The interest that they're paying on it is 6%. Now the loan period that they have on the loan is 60 months or 5 years. The minimum payment is going to be $205 per month, and the total interest is going to be $68,000 that they owe, or that they would pay if they just did the minimum payment for those 5 years. Now I did use the payoff calculator that I have on my Patreon to figure these numbers out. So this is the true total interest that somebody would pay if the terms were exactly like this. So we're going to move to the other side of the board and see how we can use our HELOC to reduce this total interest on the loan. All right, so we're on the other side of the board. What we're going to do first is just kind of break down every section of the table here so we understand every section basically. So first section, self-explanatory, we have the months, so every single month. The second row is going to be our HELOC. So this is what we're going to be having left on the HELOC. So for example, we would have $61,000 left on our HELOC, meaning that we would have like $39,000 that we owe. So this is how much that we have on the HELOC. The next column, the debt column, is actually the debt on the loan. Since we understand that for velocity banking, we use our whole line of credit to pay off the debt, or we use the line of credit to pay the whole loan off, you're just going to see a zero column. The next column is going to be the HELOC interest column. So we're going to be doing the simple interest equation every month, and we will see how much interest we're going to be paying every single month on that HELOC that we borrowed here. And then the next line is the actual loan interest. So this would be if we just paid the loan, the minimum payments every single month. We're going to be looking at the interest and how it goes down if we just did the regular way so we can compare. So what we first want to do, we're going to go down to step 1. So we know that our loan is $40,000. So what we're going to do is we're going to use our line of credit, our HELOC. We're going to take $40,000 out of the $100,000 that the bank gave us here. We're going to pay that loan off in full. What that is going to do, that is going to increase our cash flow, because remember, the minimum payment was $205. Since we don't have the loan anymore, it increases our cash flow by $205, and it decreases our expenses by $205 because the minimum payment is no longer an expense anymore. So we're going to go down to our next section here. So the couple's income is $5,000 every single month. So no matter how they get it, weekly, bi-weekly, monthly, they get $5,000 in that month. They're going to use their income. They're going to dump all of it into their line of credit. Now, remember, since we have to use $40,000 of the $100,000, we would have had $60,000 in our line of credit. They're going to put $5,000 extra in the line of credit, which is going to make it that $65,000 that we see right here. Now, how are they going to be paying their expenses? They're going to use their line of credit. They'll have $65,000, and then they'll use that to pay their expenses. Now, remember, the expenses were $4,000, but since we paid off the loan and it reduced our expenses down $205, then our total expense is $3,795. If we do the math, $65,000 minus the expenses, we're going to get $61,205 pretty much right here for our HELOC. So that's as much as we have on our HELOC. Now, our next section, what we're going to have to do to calculate the simple interest on how much we pay for the month, we're going to have to use the debt on the line of credit. So the way to find the debt on the line of credit, we would just take the $61,205 we'll minus that by 100,000 because that's our limit on the home equity line of credit. So that difference would equal 38,795. Now we're ready to use our simple interest to calculate it here. So we're going to times that by 0.035. That is our 3.5% on our HELOC. And then we're going to divide that by 12 because there's 12 months in a year. We're going to get 113.15 cents that we paid for our home equity line of credit interest. Now, if we would have just made a regular payment on the loan and didn't use our line of credit, the loan interest would have been $200. So we already see that we are saving money by just using the HELOC to pay that off and then just pay the HELOC back, because the loan interest would have been $200. Now, one thing to note here, the interest for the home equity line of credit, it can differ, because remember that we don't know when they're going to be getting that $5,000. It could be coming weekly, bi-weekly. So this equation changes up. Let's say that they had $1,000 for 1 week. This would be, let's say, 39,000 times 0.035. And that will give you a different number. So every single day, whatever is on the debt owed on the line of credit, that's what they're calculating by. But we're just going to use a round figure. So 113, it could be a little less, it could be a little more, depending on when you're actually getting that $5,000. All right, so we're in the month of February. Just some quick notes. I do have magnets on it. So we see that our expenses, they went down to $3,795, and our cash flow increased by the 205. So we have $1,205. So please take note of that. Second, with the first equation, we are pretty much done with that equation because the loan is completely eliminated. So we are not going to be using this equation anymore. So we're always going to go down to step 2. So step 2, what we're going to be doing is using our income, our $5,000, and we're going to be putting it onto the line of credit. So the end of January, we remember our line of credit was $61,205. We're going to put $5,000 into that, which is going to be $66,205. Now, the next step of what we're going to do, we're going to use the line of credit, the $66,205, and we're going to pay all of our expenses out of our line of credit. This will leave us at $62,410 for the month of February. So we see right there. Now, what we're going to do, right? We're going to take the difference between 100,000 and the 62,410. We're going to get a debt owed on the line of credit of $37,590. Times that by 0.035. Divide that by 12 because there's 12 months in a year. Our interest is going to be $109.60. So we see that right there, $109.60. Let's look in the month of February for the loan interest. If we were just to pay the loan, the monthly minimum payment, that'd be $199.97. So if we look at it, it went down by 7 cents, the interest on the loan, if you're just paying it monthly. Now for our line of credit, we see that it is going down at a way higher rate, way faster rate, and we're paying lower in the interest. All right, so we're on the month of March. So pretty much we're kind of getting a little used to it here. So we're going to look at the month of February here. At the end of February, our home equity line of credit was $62,410. We're going to already go to step number 2. We're going to use our income, our $5,000, whenever we get it, weekly, bi-weekly, monthly, whenever we get it, we're going to put that on to our line of credit. So our line of credit is going to now equal $67,410. Now, the next step is we're going to take our line of credit, our new line of credit, and we're going to pay our expenses, the $3,795. We're going to be left with $63,615. at the end of the month for March. Now let's calculate the home equity line of credit interest that we have to pay here. So the debt on the line of credit, we're going to have to do the difference between 100,000 and 63,615. That difference is going to be 36,385. Going to times that by 0.035 because our home equity line of credit was 3.5%. Divide that by 12, and we're going to get interest of $106.72. So we see it right there. Now we see that it's gone down by about, $3 in our interest. If we look at, if we're just paying off the regular loan interest, it is now $199.94. So it went down by 3 cents in regards to interest if you're just doing that minimum payment and we still have the loan. All right, so we're on the month of April here. So what we're going to pretty much take a look at is what our line of credit was at the end of March, which was $63,615. And what we're going to do is whenever they get their income, the $5,000, they're going to put that straight on to there. So our line of credit will be $68,615. And once we do that here, we're going to use our line of credit to pay off our expenses, the $3,795. We're going to end up with an amount of $64,820 for April. So now we just want to calculate the interest on how much interest accrued for April using that home equity line of credit. So again, we got to take the difference between 100,000, pretty much the line of credit limit for the loan here for our line of credit, and the 64,820. Once we minus that, we're going to get the debt on the line of credit, which is $35,180. We already know we're going to times that by 0.035, which is the 3.5% interest on the home equity line of credit. Divide that by 12, because there's 12 months in a year. We're going to see that we paid $102.60 in interest. Now, let's take a look at the loan interest, see how that's accruing here. So if we made a minimum payment in the month of April, if we still have the loan, it went from $199.97 we paid in interest for the previous month to $199.91. So 6 cents reduced on your interest if you just pay that minimum payment on the loan. All right, we're in the month of May and we're getting used to things, but we're going to drill it in our head of what we're doing here. So for the month of May, we got to look at the month of April. The ending of April, our home equity line of credit has $64,820 on it. So what we're going to do is use that $5,000 income that we get. We're going to put that onto the line of credit, which is going to increase it by $5,000. We're going to get $69,820 on our line of credit. We're going to then use our line of credit to be paying our expenses. Our expenses are $3,795. We see that's going to leave our HELOC at $66,025. Now, what we got to do here, we're trying to calculate how much interest we pay. So we're going to take $100,000. We're going to minus it by $66,025 to get the debt on the line of credit, which that will be $33,975 times it by that 0.035, the 3.5% on the HELOC. Divide that thing into 12, and we see that our interest is $99.09. So we're down to double digits. So let's see what it's looking like if somebody just didn't use the home equity line of credit to pay the loan off and they just did the minimum amount here. We see that they're paying $199.89. So that's crazy. I mean, it's what it went down by 3 cents. Like, that's ridiculous here. So these people are pretty much hurting in interest that they're paying compared to the couples that's using their home equity line of credit to pay the loan off and then pay the home equity line of credit off in simple interest instead of that amortized interest. All right, we're in the month of June. We halfway through the year, so we getting the hang of it, but we about to knock it out here. So for June, we already know we have to look at what our HELOC was at the end of May, which was $66,025. We're taking our $5,000 of income. We're putting that onto the line of credit. We see that the line of credit will be raised to $71,025. When we do that, we're going to be using our line of credit to pay our expenses off, and our expenses are $3,795. We get a total of $67,230 for the end of the month for June. Now we want to calculate how much interest we paid on the HELOC here. So we're going to take the $100,000 of what we were granted for the HELOC, minus that by $67,230. This is going to give us the debt on the actual line of credit here, which is going to equal $32,770. Times that by the 0.035, that's 3.5% on the HELOC. Divide that by 12. We're going to get a total interest of $95.57. Let's take a look at the struggle couple. That's what I'm going to call them, the struggle couple that's just paying that minimum payment here. We're going to see that now they're paying $199.86 goes to interest. And remember, the minimum payment is $205, so it's like $5 right now is getting paid off on the principal, and that's freaking crazy, man. All right, so we're in the month of July. We getting used to things here, so let's just go ahead and knock it out. So we got to look at our line of credit, what it was at the end of June, which is going to be $67,230. We're about to use our income, our $5,000 right here. We're going to put that onto the line of credit. It's going to increase that thing to $72,230. We're going to then use our line of credit to pay our expenses. That's going to equal $68,435 that we're going to have for the end of July. Now we just need to calculate the debt on the line of credit that was paid out in regards to the interest. So what we're going to do is the $100,000, we're going to minus that by $68,435, and we're going to get a total of $31,565. We're going to times that by 0.035, the 3.5% on our HELOC, divide that by 12, and we're going to get a total interest of $92.06 for that particular month. Now let's check on our struggle couple here. They are now paying $199.83 in interest on their loan when they do that minimum payment. All right, we're in the month of August, month 8. I think we know what we're doing. We should be knowing what we're doing, but we're going to break it down. We're going to get to the end of the year here. So for August, we have to look at our line of credit, what was on it in the end of July. So that's $68,435. What we're going to do here, we're going to use our income, our $5,000. We're going to put that onto the line of credit. So that is going to equal the $73,435. So once we do that here, we're going to look at the line of credit. We're going to pay our expenses. Once we do that, we're going to end up with a balance on our line of credit of $69,640. Now, what we want to do here is look at the interest that we paid for the particular month of August. So we're going to take our $100,000, minus that by $69,640 to get the debt on the line of credit, which that is going to equal $30,360. We're going to times that by the 0.035, which is 3.5% on our home equity line of credit. Divide that by 12 because there's 12 months in the year. We're going to get an interest of $88.55. So let's check on the struggle couple again here. Now they're at a whopping $199.80. So 3 cents went off on that interest, while we're consistently getting $3-4 off of the interest every single month. All right, so we're in the month of September, month 9. I know we know what we're doing, but we're gonna knock this out here. So for September, we gotta look at what the line of credit was at the end of August here. So we have $69,640. We're gonna use our income of the $5,000, put that into the line of credit. We're gonna have $74,640 on there now. We're going to use that line of credit to pay our expenses of $3,795. That's going to give us a total of $70,845 on our HELOC at the end of September. Now we want to know how much interest that we paid in September here. So we're going to take 100,000, we're going to minus that by 70,845. This gives us the debt on the line of credit, which the debt right now is going to equal $29,155. We're going to times that by the 0.035, which is a 3.5% interest on the line of credit. We're going to divide that by 12, and our interest for that month is going to be $85.03. We're going to look at our struggle couple here. They're at $199.77. So it looks like another 3 cents went off on interest on the loan if we were just to be doing the minimum payment and paying off the loan and not using our line of credit to pay the loan off and pay the line of credit back in simple interest. All right, so we're in the month of October. I know we know what we're doing, but we're gonna keep on going, knock out the rest of the months here. So for October, we're going to look at what our line of credit was for September, which was $70,845. We're going to use our $5,000 of income, put that onto the line of credit. We're going to get $75,845. We're going to then use our line of credit to pay our expenses, which are $379 This is going to equal $72,050 onto our line of credit for October. Now we just want to see how much interest we paid for the month of October. So we're going to take our $100,000 minus that by $72,050. This is going to give us our debt on our line of credit, which is equal to $27,950. Going to times that by 0.035. That's the 3.5% on our home equity line of credit. Divide that by 12 because there's 12 months in a year, and we're going to get $81.52 that we paid in interest for the month of October. Now let's look at struggle couple here. They got $199.74 in interest. And please remember, their minimum payment is $205. So not a lot in this first year of the loan is going towards principal. All right, we're in November, month 11. We know what we're doing, and we're knocking out this line of credit here. So for the month of November, we need to see what the line of credit was in the end of October, which was $72,050. What we're going to do, simply just take our income of $5,000, shove that thing into the line of credit. It's going to equal $77,000, and it's going to equal $77,050. Then we're going to take that line of credit. We're going to pay our expenses with it, and that's going to equal $73,250 for the end of November. Now we need to figure out what is the interest that we paid for the month of November. So we're going to take $100,000, we're going to minus that by the $73,250, which is going to give us our debt on the line of credit. So that's going to equal $26,750. We're going to times that by 0.035. That's the percentage on the home equity line of credit. Divide that by 12 because there's 12 months in a year. We paid $78 in interest on the HELOC for that particular month. Now let's look at struggle couple here. they're paying $199.71 now in interest on the loan by just paying that minimum payment. All right, so we're in the last month of the year, December. So let's get this knocked out here and see what we have learned overall. So for December, we have to look at the line of credit, the ending of November. So that will be $73,250 is what we had on the HELOC here. So we're going to use $5,000 of our income, pretty much our whole income, throw that into the line of credit. We're going to get $78,250. We're going to use that and we're going to pay our expenses. Our expenses are $3,795, which will leave our line of credit at $74,460. Now we need to see what the interest we are paying on the line of credit for December. And to do that, we're going to take $100,000. We're going to minus that by $74,460. And we're going to get the debt on the line of credit currently, which is going to be $25,540. We're going to times that by 0.035, pretty much the percentage on the HELOC. Divide that by 12 because there's 12 months in the year. We're going to get $74.49 that we paid in interest on the line of credit. And let's look at struggle couple here. Looks like they knocked out another 3 cents. So they paid $199.68. So as we can clearly see, when we use the home equity line of credit to pretty much knock out the loan and then pay the line of credit back by stuffing our whole income in there and then taking out what we need to pay our expenses, we see the interest, first off, we're pretty much paying like half to begin with, and it just keeps on going down by a very higher increment than just paying that minimum payment on the loan. So adding those up, I did it already, and adding it up for the home equity line of credit interest, it was a little over $1,100 that we paid for that year. For the actual loan, we paid a little bit over $2,400. So we saved half that amount by using the home equity line of credit to pay off the loan and then paying off the home equity line of credit. Now, a question that will probably be raised is, hey, what if I just took my cash flow of $1,000 and I just put it onto the loan? Yes, that would pay it off faster, but there are a couple things about that we need to know. Now, first off, the home equity line of credit way is still going to be faster, and you're going to have less interest. But if you use the other way, that cash flow is usually a lot of people's emergency fund. So with the home equity line of credit, let's say for January, I have $61,205 in there. So if an emergency happened, I would just take some money out of the home equity line of credit and pay that emergency and still keep doing that same process. It would just be added to my expenses list. Now, if you use that $1,000 of cash flow for that extra payment, let's say you did that and then you had an emergency after, you can't go to the loan, you can't go to the loan company or something and say, hey, can you give me some of that money back? They're gonna be like, no, you already paid for it. So remember that these lines of credit, you can put the money in and immediately take it out. So it is an emergency fund. So definitely recommend this way. It's still faster and you already have an emergency fund built in because you're able to take this money out anytime you put it back in. So I hope this was helpful for everybody. Remember, smash that like button for me. If you have not done so yet, definitely subscribe to the channel. It does help me out. It helps the YouTube algorithm and it helps me reach a higher audience base. Also, remember to leave a comment, even if it's like good job or if there was something that I missed or some numbers that I missed, definitely let me know. Comments are definitely welcome. And like always, you guys have a good weekend. Peace out.